Hi and welcome to Swissquotes Daily Market Talk. It's Friday, February 21st. The US dollar gave back gains this week despite trade and geopolitical tensions, the hawkish Federal Reserve meeting minutes, and interest rate cuts from two major central banks, while the Chinese equities continue to extend their gains on the back of AI optimism. So hi again everyone, and thank you so much for your nice feedbacks and your interaction with the educative episodes that were actually posted at the beginning of this week when I was off to my holiday. So I will be getting back to you soon on these comments, and I have been taking notes for the new requests. But first, let's close this week here. So the last few days of trading were actually marked, of course, by Donald Trump's tariff threats, geopolitical chaos, mounting international tensions across the globe that led to fresh record highs in gold prices, but also interest rate cuts from two major central banks, further optimism on Chinese technology companies, hope for Intel, actually, I'm not going to talk in this episode, and disappointing forecast from Walmart as well that I'm not going to be covering in this episode. But let's start with tariffs and get it out of the way, of course, and then we can attack the Chinese and the FX stuff later on. So Trump said earlier this week that 25% levies would probably be imposed on cars, chips, and pharmaceuticals, but didn't really provide clarity on whether the cars made under the free trade agreement in North America with Canada and Mexico, for example, would be impacted by these tariffs. So we guess that the most exposed to the US car tariffs will be the South Korean and German car makers. So it could be why we saw this week the German DAX index giving back some of the earlier gains, along with the rising political tensions in Germany into this weekend's snap election that will probably throw Germany toward the right side of the political landscape. So more on that on Monday, and more details on tariffs are expected to land around April 2nd. But more specifically on the European front, while the US pulling back its much important military support is reviving discussions in Europe about how much we could spend here on defense to get the European armies up to date and how to finance these new and unexpected costs. At this point, well, the picture is not shiny, but I start thinking that the US safety shocker in Europe could wake up the sleeping European beauty somehow and boost things in Europe, but we know that it will take some time, so we'll be looking at it very carefully, still knowing that European economies can't catch up their delay in technology, for example, overnight, but hope is life. While on the Chinese front, note that the news are surprisingly, not only that Xi Jinping met with the Chinese big technology leaders to show off now their improved relationships, but Donald Trump also said that there could actually be a trade agreement with China, as he's got a great relationship with Xi Jinping. How surprising, right? And to top it all, Alibaba announced strong quarterly results this week, its fastest growth in a year, and said that AI is their primary objective. So Alibaba shares gained more than 12% in Hong Kong at today's trading session, and they're up by more than 75% since the middle of January on the AI hub. Now, remember that this Chinese AI story is developing fast these days, with Alibaba's own AI model on one hand and DeepSeek's ChatGPT-like AI model on the other hand, that both feed into many companies' services. Apple, for example, they chose to integrate Alibaba's AI model in its Chinese iPhone models, hoping to boost sales in China, while BYD and Tencent, for example, which is a provider of the Chinese WeChat application, these two companies are teaming up with DeepSeek to enhance their own services. And the Chinese companies' ambition, this envy to integrate the AI models into existing services in a fast fashion is obviously boosting appetite for investors globally, along with Xi Jinping's most obvious support for the technology companies these days. As such, the Hang Seng Index is testing the highest level since last October this week, with some great upside potential to recover more the post-technology crackdown and post-pandemic losses. And the mainland China's CSI index is extended gains as well, slowly but surely. This time, as I said in previous episodes, Xi Jinping knows that this is a golden opportunity to restore investor appetite and shift investors' attention away from the property crisis and the demographic issues in China and also the economic headaches. Therefore, I genuinely believe that the Chinese technology rally has more room to develop from here, even more so as the Chinese technology stocks are trading at significant discounts compared to their US counterparts. Because the Nasdaq's Golden Dragon Index, for example, which tracks major Chinese technology companies listed in the US exchanges, is trading at a forward PE ratio near a record low level relative to the Nasdaq 100 index. Elsewhere in the FX markets, while the US dollar continued to give back the recent gains this week, and that despite the tariff talk from Donald Trump, the interest rate cuts in Australia and New Zealand, and also despite the hawkish sounding Federal Reserve minutes that actually hinted that the Fed officials were inclined to keep the interest rates in the US unchanged until they see further progress on inflation before making additional adjustments. So the US dollar index tested the 100-day moving average to the downside yesterday, and the index is now consolidating near this level this morning. The major support to the September to January rebound, or say the Trump rebound, is seen near the 106 level. Now, a move below this 106 level could eventually mark the end of the knee-jerk Trump rally in the US dollar and send the greenback into the medium-term bearish consolidation zone, and hence let the major peers regain some more ground, and that despite dovish expectations from their central banks. In this context, the Reserve Bank of Australia cut its interest rates this week for the very first time in more than 4 years, but the Aussie dollar spent the week recovering losses. The euro dollar, on the other hand, well, the euro dollar remains under some decent downside pressure except yesterday's rebound, as the European Central Bank here and the European Central Bank expectations, well, they remain quite soft and sweet, and that despite a higher than expected CPI print that we saw from France this week, because the European Central Bank is expected to pull its interest rates below the 2% level to help the underlying European economies deal with the economic weakness of the moment and also the US threat. So the latter, divergence between the European Central Bank and the Federal Reserve policy expectations, should keep the Eurodollar's upside potential limited above the 105 psychological level. Across the channel, sterling hawks got a boost this week from the higher than expected CPI report from the UK released earlier this week, which actually showed that the headline inflation in Britain returned to the 3% mark in January. Now that report, combined with the US dollar's recent weakness across the board, will send cable drilling above the 126.50 level, which is the major 38.2% Fibonacci retracement on September to January sell-off in cable. As such, the pair has now freshly stepped into the medium-term bullish consolidation zone, and that means that the pair could eventually extend its gains on the back of more hawkish Bank of England outlook on this higher than expected CPI report, and hope that Britain could maybe get less harmed by Trump's tariff policies, even though note that the growth outlook for Britain is on a slippery ground right now, and Rachel Reeves' growth plans for the UK are not going according to the plan. On the contrary, consumer confidence in the United Kingdom sank to the lowest level since Labour came to power. And lower confidence and lower spending from households means trouble for the UK economy that relies heavily on services. So, my conclusion is that the cables rally these days could bump into solid offers near the 200-day moving average that stands just a few pips below the 128 psychological mark. So this is all for this short week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.